Hello everyone, this is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you my North American opening market comment for Wednesday, August 17th. Well, the UK employment data this morning was pretty good. The number of people claiming jobless benefits actually fell instead of rising as was expected. But that only gave a temporary boost to the pound, and the currency is lower again against both the dollar and the euro. As for today's U.S. indicators, the first one on the schedule is the Department of Energy's oil inventory data. The market's forecasting another rise in oil inventories in line with the recent trend. Gasoline inventories, on the other hand, are forecast to decline, and that seems to be the number everyone's looking at now. However, yesterday's data from the American Petroleum Institute showed a large increase in gasoline inventories, which sent oil prices down. If the Department of Energy stats do show a drawdown in gasoline, then I expect oil would rally, even if inventories of crude oil rise overall. St. Louis Fed President Bullard speaks on the U.S. economy and monetary policy. He's a pretty dovish guy who said recently that he expects rates to be about flat over the next 2.5 years with just one rate increase. Now, his comments today are likely to be a sharp contrast to New York Fed President Dudley's speech yesterday. Dudley said the Fed is edging closer to its next rate hike. So, which view is dominant at the FOMC? That's what investors will want to learn when the committee releases the minutes of its July 27th meeting today. If more members of the committee agree with Bullard that it's no longer possible to forecast when the economy will break out of its low-growth, low-inflation state, then policymakers could afford to wait until inflation actually becomes a problem before raising rates, rather than having to hike in advance of any inflation, which is the way that central banks now operate. Any signs that the committee is starting to change the way it thinks about the risks of inflation could signal a slower than expected rise in rates and therefore be negative for the dollar. Finally, overnight, Japan announces its July trade figures. The trade surplus is expected to fall. Exports are expected to collapse, but imports are expected to fall even further. A collapse in exports and a fall in the trade surplus could heighten speculation about further Bank of Japan action and thereby weaken the yen. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.